Hello everyone, in this video, we will explain the accounting cycle of the Badan Usaha Milik Masyarakat Adat Namblong or BUMA for short. Before we dive into the accounting cycle, it's important to first understand what a BUMA is. Badan Usaha Milik Masyarakat Adat or BUMA Papua is a business entirely owned and managed by indigenous communities with the main objective of improving the welfare of indigenous peoples in Papua through the management of natural resources and local wisdom-based economy.
Buma Mare and Namblong was formed as initiative of the clans of the Namblong and Mare subtribes to help empower the economy of indigenous peoples in the Mare and Namblong regions in Papua.
Now that we have understood the background and values underlying the establishment of BUMA, we move on to the explanation of BUMA's accounting cycle. So, the accounting cycle starts from the most basic thing, which is proof of transactions. Every sale, return, or payment activity is recorded based on evidence such as first, sales invoice, a document issued by the seller to the buyer as proof of a sale of goods or service on credit. Second, cash disbursement voucher, a document that records cash disbursements from the company. Third, cash receipt voucher, a document that records the receipt of cash or cash equivalents into the company. Fourth, memorial voucher, a document used to record non-cash transactions, which are transactions that do not involve direct receipt or expenditure of cash. And the last is cash invoice, proof of a cash purchase or sale transactions made by the seller and given to the buyer. Transaction evidence is used as the basis for recording every financial activity. From there, transactions are recorded in general and special journals. Special journals are used to record transactions that occur frequently and repeatedly so that recording is more efficient and neat. In a merchandise company, special journals are usually divided into several types, namely, first, purchase journal, to record purchase of merchandise on credit. Second, sales journal, to record sales of merchandise on credit. Third, cash payment journal, to record all cash disbursement transactions. And the last is cash receipt journal, records all cash receipt transactions. Meanwhile, transactions that are not routine or cannot be entered into a special journal will be recorded in the general journal. For the example is recording returns, error corrections, or other adjustments.
After a transaction has been recorded in a journal, either a special journal or a general journal, the next step is to move the data into the ledger. This process is called posting. The ledger serves as a place to group all transactions based on the type of account. That way, we can prepare financial statements more easily and systematically. In addition to the main ledger, subsidiary ledgers are also used in merchandise companies. This subsidiary ledger is usually used for accounts receivables and account payable. The subsidiary ledger records details of transactions with each customer or supplier. This means we can track transactions in more detail without overloading the main ledger. The first, for the example, in the account receivable subsidiary ledger, you can see in detail how much each customer's total outstanding bills are. And the second, the same goes for the subsidiary ledger, which records how much the company owes to its supplier. With subsidiary ledgers, companies can control and monitor receivables and payables balance in detail without having to fill the main ledger with too many details.
After all transactions have been posted to the ledger, the next step is to prepare a trial balance. The trial balance is prepared by adding up the ending balance of each account in the ledger. The goal is to ensure that the total debit and credit balance are balanced. Next, we will look at the raw material inventory and production cost calculation table in the accounting cycle. Raw materials are items purchased and stored for use in the livestock production process, such as feed, vitamins, and other supplies. In recording, we use the average method, which calculates the average value of all raw materials purchased during a certain period. The goal is to have a uniform price per unit when the materials are recorded as part of the production cost. Production cost is the total of all costs incurred by the company to process raw materials into goods ready for sale. For the example, in an indigenous livestock business, such as native chicken farming, production costs include all expense during the breeding period from the start until the chickens are ready for market. So, when we say ready to sell goods, we're talking about chickens or other livestock products that have been raised and are all set to be sold. By using the average method, we calculate the per unit value of ready to sell goods based on the average of the total production cost per head or per unit, making it fairer and more consistent in the financial statement. After compiling a table of ready-to-sell goods using the average method, the company records the inventory mutation. In this mutation report, the movement of each type of inventory is recorded from the initial balance to incoming goods and outgoing goods. By recording mutations properly but thoroughly, the company can find out the final inventory value of each type of item. After completing the inventory calculation, the next step is to prepare an adjustment journal. This journal records transactions that have not been recorded or need adjustment. After all adjusting journals have been created, the data is entered in a worksheet or balance sheet. The goal is to simplify the process of preparing financial statements and ensure that all adjustments have been recorded correctly.
After preparing the adjusting journal and balance sheet, we reach the most important stage of the accounting cycle, the financial statements. Financial statements present a company's financial information for a given period and are the primary basis for evaluating its condition and performance. In general, financial statements consist of the following main components. First, the statement of residual income. This report shows the net profit earned by the cooperative after deducting all operating expense, depreciation, debt, and taxes for a given period. Next is the report of retained earnings, which is the portion of net profit not distributed to members or owners but kept by the company for future operational or business development purposes.
The third component is the statement of change in equity. This statement shows change in owner's capital, such as additions from retained earnings or capital deposits and reduction from capital withdrawals during one accounting period. Next is the statement of financial position, also known as the balance sheet. This report shows a company's assets, liabilities, and equity at a given point. Finally, there is the cash flow statement. This report details a company's cash inflows and outflows over a given period, whether from operating, investing, or financing activities. After preparing the financial statements, we move on to the journal. This journal closes temporary nominal accounts such as income and expense. After the closing journal is posted, a closing trial balance is prepared. Its purpose is to ensure balance after all temporary accounts have been closed. After completing the entire accounting process, including closing the journal and balance sheet, the final step in the cycle is preparing the performance report. The performance report records and presents the company's work results in carrying out tasks and achieving goals during a certain period. This report compares the actual results with previously set targets or plans, allowing for an evaluation of performance, effectiveness, and efficiency. In general, the performance report includes four main types of ratios. First, the liquidity ratio measures the company's ability to meet its short-term obligations using its current assets. This ratio shows how quickly a company can convert assets into cash to pay its debts. Examples of this ratio are the current ratio and the quick ratio. Then the profitability ratio assesses the extent to which the company can generate profits from sales or the use of its assets. These ratios demonstrate the company's efficiency in generating profits. Examples include net profit margin, return on assets or ROA, and return on equity or ROE. Next is the solvency ratio. This ratio measures a company's ability to meet its long-term obligations and shows its financial risks. Example of this ratio include the debt to equity ratio and the debt ratio. Last is the social and environmental ratio. This ratio measures the social and environmental impact of a company's activities. This includes contributions to society, compliance with environmental regulations, waste management, and corporate social responsibility or CSR programs. By compiling this performance report, companies can assess their achievement from financial, social, and sustainability perspective. Okay guys, that was our explanation of the accounting cycle in the Badan Usaha Milik Masyarakat Adat Namblong. Hopefully this explanation will help you understand the flow of financial records from start to finish. If there are parts that are not clear or if there are mistakes in the explanation, we apologize. That's all and thank you for watching.